So I'm recording now. It's officially starting. Jack, if you'd like to tell everybody who you are, and then we'll just get started with the class.
Sure. Thanks for the intro. I am Jack Laurent. I've been in the mortgage business since '98, both as manager and loan officer. I've been specializing in Summit County lending for about the last 3 or 4, maybe 5 years now. I've owned in Summit County for the last 15 years, and I'm on the finance committee at the Village of Breckenridge. So I understand condos, I understand Summit County. And I was getting questions from realtors that seemed to fall into 2 general categories. And that's when I approached Michael and said, hey, listen, I'm getting a lot of questions. Maybe there's an opportunity to answer a lot of questions at one time. And so just started putting together some of the questions, and the material kind of wrote itself. So there are going to be some questions. That's fine. And what Michael suggested is using the Q&A rather than the chat. And go ahead and send the questions in as you think of them. And there's a good chance that I'll answer it. Hopefully there's a good chance I'll answer it during the presentation. And at the end of the presentation, I'll kind of walk through the questions, and those that were not answered in the presentation, I'll go ahead and address at that time. If it's something that's more of an offline question or a specific situation question, by all means, feel free to give me a call. To contact me offline. First of all, I'd like to tell you that I appreciate your time. I think everybody on this call, like myself, or the vast majority of us anyway, are on commission and have been on commission for a long time. And I value the time of people on commission because I know that you could be using this time to work on the people that you're incubating, to make yourself better through classes, through whatever. So I appreciate your time. I understand that this is not that lockdown doesn't mean you've stopped working. We all are in this together, and that's kind of the reason to put this together and kind of answer some questions. So the title that we're looking at, the screen we're looking at now, what are things going to look like? We know that buyers and sellers are going to come back. Mountain living, skiing, hiking, mountain biking, all that stuff is not going away, and people are actually building up a pent-up demand in order to do it. So what are things going to look like? Where are things now? And just sort of give you an update of what the challenges are. There's a couple key phrases that I want you guys to learn because it is integral to the lending process. So we're just going to kind of walk through these together. Wait a minute. Come on. There we go. Sorry about that. So the questions I was getting were kind of into 2 general categories. They were questions about the finance markets, what's going on now, what can we expect to happen, and how is the coronavirus impacting the mortgage lending process right now? If you are able to put together a buyer and a seller, are there still products? What are rates going to look like? Those sort of questions. So these are sort of the topics that we're going to be talking about over the next hour. What's happening right now in the market, understanding mortgage rates versus federal funds rate. I know a lot of us have talked to people that are considering buying, and they want to wait until the next Fed meeting because they're going to lower rates. And while you can't convince people, you can't change their belief systems about how rates work and how money works. At least I can help educate you guys so that you understand how these rates are set, where they're coming from, and waiting for the next Fed meeting to change rates is really sort of a waste of time. Rates right now are still generally pretty low. I looked this morning, rates on let me check over here. Rates on a primary residence, single family residence are about 3.5%. Historically, that's fantastic. Those of you that have been in the industry for a long time or have worked with older clients, they understand that 3.5% is ridiculous. It's, historically, we're still in a trough in terms of rates. It seems like younger buyers still want something in the high 2s. They don't understand that these are fantastic rates. A second home condo would be about 3.75%, still a great rate. Investment condo is going to be over 5%. And that's where the risk is seen by Fannie Mae, and that's where the risk is seen by the market. Is in investment condos that have a high HOA are also going to have a high default ratio. So the way they curb the input of those files is they make the rate very high, and it works like a charm. So you would actually need to pay a discount point to get 5% on an investment condo right now. And a lot of that's because we don't know what we don't know. We don't know how this is going to shake out. So that's where rates are now. And again, historically, these are fantastic rates. These are when you can put together a buyer and a seller, it is going to be an attractive loan package in most cases. Many outside the box lenders have stopped or slowed lending. They are unable to sell the loans that they have, and so they can't originate new ones. So there are pipeline issues for lenders who do outside the box loans, and I'll explain why that is. I'll give you an update on jumbo lending. That's one of the types of lending that's more common, certainly in Summit County, than it is, say, in the Denver area. And you guys are aware of what's happened to values up there. Regarding the coronavirus itself, can a lender close a loan for a buyer who's currently on furlough or reduced hours? What's happening with appraisals? People don't want appraisers coming in. Appraisers don't want to go in. So drive-by appraisals are being allowed in certain situations. Mortgage or rent payment forbearance. This is Pandora's box. This is one of the things that, having gone through the 08-09 crash, I know that this backfires on people a lot. So I want to kind of educate you on it so that you can educate the people that you're incubating. That's the goal of this, is to give you an understanding of what's going on and help you manage the people that you're incubating. So the forbearance, while tempting, is something that I really want to talk about and go into detail on later on, because it looks super tempting, but we just need to hit the brakes a little bit and really understand what's happening, especially again for the people that you're incubating. Why Summit area is different. The fact that people can't drive by a condo in Summit County if they live in Ohio. Rates on second homes, rates on condos, those sorts of things are specific to Summit County. Summit County has some out-of-the-box products because there are out-of-the-box homes and there are out-of-the-box buyers. And again, the messaging for the clients that you're incubating. So let's kind of walk through these. What's happening in real estate finance right now? The conventional loan process, and conventional loans, when I say conventional loans, I essentially mean Fannie Mae, Freddie Mac, good old American, fits inside the box lending, not jumbo. Conventional lending, and the rates that I gave you just now were conventional rates. Conventional lending process is normalizing. Processes are in place for appraisals. Right now, and I think we'll go into detail later on, but right now Fannie Mae is allowing drive-by appraisals. And when I say Fannie Mae, I essentially mean government lending in terms of Fannie Mae, Freddie Mac, and Ginnie Mae. They all essentially do the same thing. Ginnie Mae focuses on FHA loans. The other two, Fannie Mae and Freddie Mac, focus on just conventional lending that's not FHA guaranteed. Verifications of employment, as you can imagine, have become very, very important. And each lender sets up their interpretation of Fannie Mae's guidance. So right now, my company, we're the 7th largest originator in the country. We're doing 3 verifications of employment. One of them has to be within 48 hours of closing the loan to make sure that you're still at the job. And in the closing package is an affidavit that your business is functioning normally and you are employed in the same capacity as you were previously. So that's the way Fannie Mae and lenders need to feel comfortable that the loan we're closing is still going to be sellable to Fannie Mae and is not going to go into default. There are remote closing types. Systems have been put in place for that. A lot of the people that are buying homes in Summit County are doing so from other locations. So one of the things that we ran into when this first happened is, how do we close a loan with a notary when there are some documents that need to be wet signed in order to be recorded? And again, conventional loan, Fannie Mae fits in the box. The bad that's going on right now is uncertainty. And uncertainty is always bad in the finance world. Uncertainty means it's very hard to establish a price or an interest rate until we get a handle. And I say we, I mean the industry gets a handle on how this all looks. And if you want to send me a message right now telling me that you know how it's going to end, please tell me, because I don't. And until the financial market can get its arms around what's going on, how many loans are going to default, what's happened to the employment rate, and we don't know when we're going to know, and we don't know what we don't know. So the main issue right now in the industry is default risk. We don't know how long the pandemic's going to last. When is somebody going to call Ollie Oxenfree, and we can all the boys and girls can go out to play? That's something that we're kind of waiting for, that magic moment. I know the stock market is up pretty sharply today because a lot of states are starting to open. Starbucks, which seems to be a bellwether of how America's doing, said that they expect to have 90% of their stores open by the end of June. So that confusion, that lack of certainty is hurting the mortgage industry, because the mortgage industry doesn't know how to create products that can be sold in the secondary market. And I'm going to explain some of that. It might get a little boring and a little dry. I hope not. I don't have any memes I can hold up to try and make you laugh or entertain you. Sorry. And there's also the chance that when the coronavirus comes back, and it's expected to come back at least at some level, if it comes back harsh, will there be future stay-in-place orders? These are the kind of things that we need to try and get an answer on. And this is almost a rhetorical question. The likelihood that industries will return to pre-COVID revenues. Many will, many won't. And those people that are in industries that continue to struggle or have been permanently changed may not be able to participate in the home buying process the way they used to. So that's sort of what's happening now. So one of the things that I generally get asked is, okay, I do put together a buyer and a seller. Is financing going to be available? And is it going to be at reasonable rates? Very valid question. That's, the thing that realtors are working for is always to make the deal, right? And once you've done that part of it, once you've done your half of it, and you've got these people together, can we actually consummate the deal? Can we actually fund the deal? Can we finance it and hand somebody keys? That's the question. So conventional lending for primary residences, second homes, and investment properties will always be here. That part's not going to go away. The federal government has made it clear that they're going to throw money at the things that they need to throw money at to keep everything working. And we'll kick that can down the road, and we'll worry about $5 trillion of debt later. But let's not all lose our livelihoods right now. So this is a stat that I know a lot of you have seen, but it's important because it's important to the government right now. National Association of Realtors estimates that one job is generated for every 2 home sales. Generating jobs is going to be critical to turning this thing around and getting back to where we were pre-coronavirus. So the federal government fully understands that. They were buying mortgage-backed securities. They were buying mortgages, which actually worked against us for a while. I won't go into the details on that, but they didn't understand that what they were doing was taking away the loans that were bought by the traditional buyers of those. So that kind of stagnated things. So Fannie Mae, Freddie Mac, they're the bedrocks of residential lending. Since they were created as quasi-government corporations, they've handled the lion's share of the lending out there. they're going to be around. I count on those like the sun coming up every morning. And what is conventional lending? Yeah, these are the limits that you see on the screen now. This is loan amount. This is not purchase price of the home. This is how much they're borrowing in order to buy the home or the condo. 750 for Eagle County, 625 for Summit County, 575 for Park County. And I think that makes up most of the area for the Summit area. And so loan amounts under that are going to be available, will always be available. The guidance might change. Some of the guidelines I would expect to change. I think the financial market was surprised at the lack of savings in America. And when you see people start to risk their health to go back to a job because they have to, that's sort of a wake-up call to the finance industry and to the federal government. Non-conventional lending is going to be in flux for some time. Non-conventional lending is essentially everything else. It also includes jumbo lending. Jumbo lending is not conventional lending. It's not backed by Fannie. It's not backed by Freddie. Generally speaking, for a jumbo loan, you need a Fannie Mae approval. And the only reason the approval doesn't work is because of loan amount. So because it's not in their wheelhouse, it's not a Fannie loan, it's going to be a private label lender that's doing the lending and trying to sell that loan in the secondary market. We'll get to that. So if you think about it, the biggest challenge right now for the finance market is default risk. If you're creating a mortgage-backed security that has loans in it that say pay 4%. The problem is 10% of those might default. So the question is, how do you price an asset when we don't know what the default ratio is, or we don't know what the value is of the asset over the next 6 months? And the answer is you really can't, not in the finance markets. Actually, probably not in any market. It's probably a general rule. But that lack of certainty makes it very difficult to establish those products because we don't really know how those products are going to perform when they're sold as an investment. Generally speaking, economic indicators point towards continued low rates in the foreseeable future. The federal government is doing what they can to keep rates low. The uncertainty in the economy is keeping rates low. Couple main bullet points here regarding interest rates. Mortgage rates are not set by the Federal Reserve. The Federal Reserve's rate right now is pretty close to 0%. The Fed rate, as it's called, or the Federal Reserve's rate, FOMC, you might see those letters, Federal Open Market Committee. That's the Federal Reserve meetings that we see that happen 8 times a year. So the rate that they're setting is the rate that banks lend money to each other on an overnight basis. Banks have certain reserve requirements. And at the end of a day's business, establishing mortgages paying off, big commercial loans, what have you, if at the end of the day, a bank is not meeting its reserve guidelines, it goes to this market because there are other banks that may have excess funds that they don't need, those funds are above their reserve needs. And if they can make a quarter point or anything on that money overnight, they might as well. So the Federal Reserve rate is the rate that banks use to lend money to each other on an overnight basis. Mortgage rates are set by market dynamics. Yes, the Federal Reserve making it cheaper for banks to lend money does have a trickle-down effect into mortgage rates. I understand that, but it is a long trickle-down effect. You probably heard it. I know I hear it a lot. Is I want to wait until the next Fed meeting because I think they're going to lower rates. Okay, so the Fed's actions are generally public knowledge well before the meeting. It is pretty clear based on the comments that I believe there's 8 Federal Reserve chairmen that they make providing guidance. There's rarely a surprise at one of these meetings. And if your buyer is talking about, I think they're going to lower rates, and I know they're going to lower rates, then Wall Street knows they're going to lower rates, and it's already built into the current rate structure. The changes that happen to interest rates from the Federal Reserve is when they do something they weren't supposed to do, which happens rarely, very rarely. We almost always know, oh, they dropped it a quarter point. And after they drop it a quarter point, I'll get phone calls from borrowers that have been on the sidelines, buyers on the sidelines saying, hey, I heard they lowered rates. And I don't want to say it in a sarcastic voice, but in my head, I'm going, yes, we've known that for a month. So the Federal Reserve does not set rates. It's a very trickle-down effect to interest rates. There are market dynamics that I'm going to talk about in a second that are responsible for rates. But whatever the Federal Reserve is going to do is public knowledge. And by the time schmucks like me know what's going to happen to interest rates, believe me, Wall Street already knows, and the large banks have already priced it into mortgage rates. So just to kind of give you an idea of that, because my concern is that given that the Federal Reserve rates are now close to zero, about the only place they can go is up. The Federal Reserve, the federal government has used several of its bullets, for lack of a better word, one of them being steering the Fed to lower rates to try and stimulate the economy. So if you think about it, a lot of buyers are going to say, well, rates can only go up. Well, the Federal Reserve rate can only go up, but that doesn't control mortgage rates. There's so many other things that impact it. We'll talk about those in a second. And this is one of the, if you can do me a favor, and Michael, and send out the question, do you realtors believe that second home buyers are more rate sensitive than primary residence buyers? I know that when thank you. Excuse me, I'm just answering the poll. So I know that I get asked when it comes to second mortgages, when it comes to second homes, I get asked, well, I'm trying to make the numbers work. I don't get asked that about a primary residence. Primary residence people are more about the monthly payment. They don't plan on renting out their primary residence. So when it comes to second homes, I see more rate sensitivity. I'm curious if you see it on your end as well. That's the reason for the poll question. And okay, so far we've got about 50-50. So about half of you have seen, 52% said do, and this may be on your screen as well. I'm screen sharing, so I guess it is. So the interest rate part of it and helping you understand what forms interest rates, I think might be helpful. Again, it's hard to change somebody's mind once they think they know how things work. I just want you to know how things work. Fair? So mortgage rates are determined by several factors. So the prices of mortgage-backed securities in the market is the #1 definer of mortgage rates. So we're going to pause here for a second, and we're going to talk about something that's very boring. It's called mortgage-backed securities. It's essentially the back end of where all the loans go. And if you can imagine, if that part of the machine isn't working, there's no place for the mortgages to go. It's hard to originate new mortgages. So a mortgage-backed security is a bundle of mortgages, and they're either bundled by the quasi-government corporations, Fannie Mae, Freddie Mac, or they are assembled by private label, the out-of-the-box lenders, including jumbo loans. So either Fannie or a private label company, private lender, will assemble a mortgage-backed security, and they then sell those to insurance companies, pension funds, large investment houses, And they sell those as a marketable security. And each one is a bunch of mortgages. That the process is called securitization, when they turn it into an asset that can be bought or sold, and those are sold in the secondary market. So the prices on those are real time. We in the mortgage industry can see what is happening to the price of mortgage-backed securities. And that's one of the things that drives future rates. So if we can tell that there's high demand, high price for mortgage-backed securities, it means that that's going to push things in a direction. It's going to tell us that there's more tolerance for even higher rates than that. So that's going to help push rates up. If there's low demand for mortgage-backed securities at a certain rate, then the mortgage industry knows, okay, we're going to need to lower rates a little bit to get demand where it needs to be. So it's real-time feedback, and mortgage-backed securities, or MBS. Now, it was part of the '08 crash. Was mortgage-backed securities have been around forever. Mortgage-backed securities became something that some lenders would gamble on, essentially, and they would create other instruments around mortgage-backed securities that created a lot of leverage in the industry, and everything collapsed. So a lot of those products no longer exist, and the mortgage-backed security is the main way the mortgage industry is fueled. So the prices of mortgage-backed securities that are already in the market are watched closely by the mortgage industry. Confidence in the economy. Higher confidence in the economy means that we expect money to cost more in the future. There's going to be more demand for money in the future if we think everything's a rosy picture. So if there's going to be more demand for money in the future, rates, especially long-term rates, are going to go up. While most mortgages never are fully paid out over a 30-year term, it's still a 30-year contract. So the pricing and the interest rate has to take into account not what's happening right now, but what's going to be happening. The average mortgage has about a 4-year lifespan, even though it's a 30-year contract. So as the mortgage industry has to think at least 4 years, and in some cases 30 years out when establishing rates. Low confidence in the economy, lower future cost of capital, lower rates. And because we're in that weird time right now, there's not a lot of confidence in the economy. And that's why buying a primary residence single-family home at 3.5%, if you told people 10 years ago, my first mortgage was 8.5%. If you had told people the rates are going to be 3.5% on a conventional loan, that would sound crazy. And so the lack of confidence in what's going to happen is one of the things that's keeping rates low. And default risk. That's also going to be a part of the pricing and a part of rates. In mid-March, banks realized they were originating loans at very low rates with an unknown default risk. ARG, I actually wrote it there on the screen. So once states started closing down in March, everything blew up, at least on my computer and in the mortgage industry, because rates rose really sharply in about a 48-hour period. And while rates were low, when the default risk wasn't built into the pricing, the mortgage industry wrote about 2 or 3 months worth of business in refinances in a 2-week period. That's how low rates got. I called a lot of people that I did loans for, explained the rate I could give them and how soon they could recoup the closing costs, and it was almost always a no-brainer. So that has been corrected. The mortgage industry, and you can imagine the salespeople like myself, we didn't call up the hedge fund managers and go, hey, these rates are too low. We took full advantage of it. We went crazy with it for the 2 weeks that we had it. Now that's gone. Don't know what's going to happen now, but while we had it, we took advantage of it. And rates rose on conventional primary residences, rose over 0.5 point in a single day, probably about 3/4 of a point. Rates on investment condos went up probably a full point in a day, which is a huge move. One of the biggest I've seen in 20 years. And again, it was as states were announcing the lockdown that we saw the mortgage industry and the finance industry really understood, hey, when a state locks down, things stop. And that's once that came into pricing, rates shot back up. And I got calls from people a week later saying, you know, I think I'm gonna jump on that. And no, that wasn't, that was a one-time offer. And it may literally, when I say that, it may literally have been a one-time offer. I was refinancing people on second home condos at 3.25%. Don't think we're going to see that again for a while. One of the things that happened in March is many outside the box lenders stopped or slowed their lending. And these are the private label mortgage-backed securities. And if you think about it, these companies were securitizing riskier mortgages, ones that didn't fit in the box. They paid a higher interest rate. They were more attractive to investors if they were willing to tolerate a little more risk. And it was either properties or borrowers that needed specialized programs that took them outside of the box. So these lenders are essentially middlemen. And by middlemen, I mean, and I get probably 10 emails a day from middlemen lenders who do outside the box lending that want to work with our company. And they don't know that I'm way down the food chain. We do 20 billion a year. I'm not really the guy to talk to. But there's a lot of these businesses that do non-warrantable condos, stated income programs, bank statement programs, asset depletion programs. An asset depletion program means they take the pile of money. This is for people that have a pile of money and don't have any income. And there's a fair number of those people out there. A lot of you have dealt with them. And what the asset depletion program does is it takes the amount of money they have and it divides it by 30, and that's their annual income. So if someone has $3 million, that's divided by 30, that's $100,000 a year. That's the income that I can work with as a lender to try and make them debt ratio. So it's these programs that are outside the box. So what happened is when they had made these mortgage-backed securities, right? They've let companies like ours originate a bunch of loans. They've taken them, they've bundled them, and they went to sell them as states were closing as the states were going into lockdown. And the people that traditionally buy these said, I don't know what you're selling me. I don't know how many of those loans, without breaking down each loan in the mortgage-backed security, the buyers didn't really know what was in there. And if the price or the risk can't be determined in the finance industry, you do not have a sellable product. So what happened to a lot of these companies is they got stuck with their inventory. They didn't have a product that could be valued, that could be accurately priced, and they had inventory that they're paying interest on to a bank because they borrowed this money in the first place. They didn't just start off with a couple $100 million. And because their pipeline was full, they sent emails to us saying, we're not taking on new loans. We will let you know when we can start taking on new loans. And it wasn't every company in the industry that does private label lending, but it was more than half. Either slowed by raising their interest rates or simply said, forget it. We can't take on any more loans because the mortgage-backed securities that we've created, we can't sell. And frankly, they're probably not going to be able to sell them until we have an understanding of what the coronavirus has really done to us financially. So because they're middlemen, they got stuck, and a lot of those outside the box programs right now aren't available. And like I said, Summit area has outside the box properties and outside the box buyers. People that have cobbled together, toy boat, people that have cobbled together several side gigs or side hustles, people that are retired. The number of people I have this almost once a month. Somebody calls me that's recently retired and would like to buy a condo. You really should have bought the condo while you were working. Really should have. One gentleman, and these are the details of Fannie Mae. This is how detailed the lending gets when you're talking about government programs. One gentleman had recently retired. He had a contract from his employer. He was chief financial officer, and part of his goodbye package was $400,000 a year for the next 5 years. The problem is, and that's good money, right? 400 grand, it's a contract, it's a multi-million-dollar company. We should be golden. The problem is Fannie Mae says that if someone is making money from a contract, if it is a financial contract that is the source of revenue for the loan, they have to have received 12 payments before that money is considered valid. And this gentleman had only retired 2 months ago. Couldn't use the $400,000 a year. Had a contract. It didn't look like this in this paper, but had a contract. And because it was only 2 months into it, and he had reserves like crazy, but it didn't follow the details of Fannie Mae. So this person who walks and talks like somebody that should be an in the box borrower was not in the box. And we see a fair number of that in Summit County, and we need some of those outside the box programs. When I say outside the box, I'm including jumbo in that. And we'll talk about that right now. Look, so jumbo loans are outside the box because they're not Fannie Mae loans. They are Fannie Mae loans, Fannie Mae approved in every aspect except for loan amounts. That's what jumbo investors want to buy. So you can create a mortgage-backed security, an MBS, of jumbo loans that are essentially A-paper loans, but they're not backed by Fannie Mae. So the reason Fannie Mae will continue to operate, the reason Fannie Mae will always be there is that Fannie Mae guarantees the rate of return on the MBSs that they sell. So if you know the rate of return, Fannie Mae says, we don't care how many mortgages default in this security. We're still going to make you whole. We will make sure that you get this coupon rate or this interest rate. That's definable. That can be priced in the secondary market. So Fannie Mae is still humming along. Conventional loans are still closing. Obviously, there's a huge slowdown in this country because of what's going on, but Fannie Mae is still operational. Their MBSs, their mortgage-backed securities are still being bought and sold in the secondary market. And it's that mortgage-backed security that eventually virtually every loan that gets originated ends up in an MBS and ends up being sold in the secondary market. The problem with jumbo loans is they're not guaranteed by Fannie Mae. So the return that they're supposed to get, we're not sure is going to stay that way if too many loans in the package default. The seller of the MBS is not going to be able to make the buyer of the MBS whole because the seller of the MBS is the servicer. And if they aren't getting enough payments, they're not going to be able to let those payments flow through to the rate of return that was promised in the MBS. And the people that buy jumbo mortgage-backed securities know that. So about a month ago, jumbo lending is virtually stopped because it was very hard to price those loans in the secondary market. Now, there were some lenders, some of the biggest money center banks, Citibank, Wells Fargo, still had jumbo products available. But they would find ways of not letting you close it or find ways of not buying it. Just because a product is on a rate sheet doesn't mean you'll ever actually get it closed. Because if the underwriting wants to get picky enough, this signature doesn't match that signature. Wait a minute, what's this deduction on this paycheck stub? You have to buy it back. Those sorts of things. That's where the challenge came, that yes, we were told there was still jumbo lending out there, but you couldn't actually get the loans closed. That was a month ago. Things have started to come back. We had, I think, 7 investors that bought jumbo loans for us for packaging. We went down to 2. We're now back up to 4. So jumbo lending, which is a part of Summit area lending, is slowly coming back. Again, it's going to be hard for it to return to pre-coronavirus levels until more is known about about the default rate, about what's really in those packages, what's really in those mortgage-backed securities. Until that uncertainty fades, and it may never go away but until that uncertainty becomes manageable in the eyes of the people that buy these investments, that buy mortgage-backed securities, jumbo lending is going to come back slowly. Right now, jumbo lending for second homes or jumbo lending for investment properties is sparse. I'll use that word. There aren't a lot of options. The lenders that are doing it know they can charge very high rates because they know there aren't a lot of options. Companies in the mortgage industry spend a lot of time looking sideways. You can imagine that as rates, while there isn't collusion in the industry, there is, what are they doing? What are they doing? What are they doing? So jumbo lending is slowly coming back. What's happening today with states reopening, stock market going through the roof, I wouldn't be surprised if in the next week or so we don't see more players coming back into the jumbo industry, and maybe some of these outside the box lenders are able to sell their mortgage-backed securities into the secondary market because people are breathing a sigh of relief, and they'll be able to offer these products to new home buyers or for refinances, what have you. So this is good news. This is the direction things needed to go. I know if these states didn't start loosening in around May 1st, around this April 27th date, if these states didn't start loosening, jumbo lending would remain sparse. So the fact that we're seeing this relaxation. Now, I know that some people on this call are thinking this is crazy. We shouldn't be going out. I know some people are saying we should have gone out a long time ago. No matter what side of that you personally feel, the stock market and the mortgage industry like it. They like the fact that anything that appears to be a return to normalcy is going to help the industry price assets better. And that's the direction that we need things to go. Again, jumbos on second homes and investment properties. I would venture to say that jumbo loans on investment properties are, when they do come back, are going to have higher down payment requirements and are not going to be at attractive interest rates. But they'll be the only game in town. About that. So let's talk about the COVID impact on the lending process. So will a lender close a loan for someone currently on furlough or on reduced hours? No. Sorry. General rule of thumb, no job, no mortgage. So it doesn't matter how much money you used to make. You were managing a fancy steakhouse. You were managing Shanahan's Steakhouse, and you were making 140 pounds a year, what have you, $140,000 a year. We expect Shanahan's Steakhouse to come back. And once it does, and once you've got a paycheck stub showing 140 grand, we'd love to talk. Until that happens, there are 0 lending options for you. And I showed Michael a text that I received. You can't actually see it. I tried to hold it up to the screen. but a borrower, Ian, texted me Monday saying, yeah, I've had a change to my income situation. And this is a guy who was looking at condos in January and February. Said, I've had a change in my income situation. Can I close a loan while I'm on unemployment? No, no, Ian, you can't. You can't buy a home. And he wanted to buy an investment property, an investment condo while on unemployment. No, Ian, you can't. And we will need a first paycheck back. And once you're back, the overall industry doesn't need to be back, but you need to be back at a job and you need to show a paycheck stub. Right now, we have to verify verify employment repeatedly. There's 10 days out, there's a written verification of employment. We have to do a verbal verification of employment within 48 hours. Fannie Mae doesn't really give a lot of guidance on this. I'm going to read you some boring mortgagees real quick. Given the current economic climate associated with COVID-19 and its impact on employment and income, we recommend that lenders practice additional due diligence to ensure most recent information is obtained. Lenders are strongly encouraged to help ensure any disruption to borrowers' employment or self-employment and/or income due to COVID-19 is not expected to negatively impact their ability to repay the loan. I don't know of really a lot of people that aren't impacted by this. And one of the documents that's in current closing packages is an affidavit saying that my business has not been negatively impacted by COVID-19. So that part of it's getting harder, and that's all Fannie Mae tells us to do. One of the things that we do need to do for self-employed borrowers, Fannie Mae used to accept proof anytime in the last 120 days, usually a screenshot from the Secretary of State that your business was operating. We now need to do it within 10 days of closing. The stocks and mutual funds that you have are given a value of only 70%, not 100% as they used to. And the money that you're bringing to the closing table, Fannie Mae has to actually see the liquidation. Meaning borrowers used to show me that they had $200,000 in stocks. Great. This is what I'm gonna, and so that means that you certainly have enough for the $120,000 down payment. And they would go get the 120 from whatever the best place for them was. Whatever asset you show me that's in file, I then need to see liquidation documentation that you've actually sold those stocks or sold those mutual funds. That's new. For a lender like Movement Mortgage, the time between closing a loan and selling it to Fannie Mae is when lenders are exposed to the greatest risk, because it's something called first payment default risk. If a borrower doesn't make the first payment on a mortgage, Fannie Mae won't buy it. If they've already bought it and the first payment comes due and the borrower doesn't make it, they will push it back down onto us and say, no thanks, first payment default. So what that leads lenders to do, like us, Fannie Mae still says that you can have a 620 score and you can buy an investment condo. Lenders like Movement Mortgage, any top 10 lender is going to create some overlays to protect themselves. For instance, in my company, to buy an investment property, you need a 720 score, because a 620 score isn't all that high. And if you lose your job, you might decide to not make payments on that investment property. So that period between closing the loan and Fannie actually buying it is the riskiest time, and lenders are protecting themselves by creating overlays or additional layers of protection on top of the guidelines that Fannie Mae would have. Appraisal guidelines from Fannie Mae. All primary, and this is at least until May 17th, all primary residence purchases can use an exterior view appraisal. Don't need to go inside. Don't need interior photos. If you are doing a second home purchase, putting down 15% or less, or if it's a cash out refinance, there has to be a full appraisal with an internal inspection. But at least until May 17th, Fannie Mae is going to accept what used to be called a drive-by appraisal. There's two methods of closing loans remotely that are becoming popular that Fannie Mae is starting to warm up to. RONs and RINs, remote online notarization. Those are documents that we have verified who you are. and the documents come to you and you can e-sign everything. The other one is remote ink sign notarizations, where a notary watches you, actually watches you sign the documents and then put the documents into an envelope to mail back for the close. Mortgage and rent payment forbearance, Pandora's box. We still got 5-10 minutes. And if you guys need to step off after an hour, I totally understand it. If we run a little long, I apologize. But one of the scariest things that I saw in 08 and 09 was people believing they were in forbearance that hadn't actually completed the process, or people that didn't understand when they needed to pay that money back. If you don't handle the forbearance process properly, you can't just stop making your payments. That's going to lead to derogatory credit, and you're not going to be able to buy a home for a long time. So you need to understand the repayment process. You need to understand whether this is going to show up on a credit bureau. You need to understand, is it, down the road, am I as a lender going to be able to see the loan used to be in forbearance? Because sometimes there's a comment section in the credit report for every trade line. Borrower disputes balance, whatever. It can also say was in forbearance. If you were an underwriter and someone needed mortgage forbearance a year ago, would you want to sell them a second home ski condo? Kind of the question. Generally speaking, a servicer is not going to wait 30 years and put those payments at the end of the mortgage. They're going to come due sooner than that. So what happens is people say, I don't have a mortgage payment for the next 3 months or the next 6 months. They spend that money. They need to save that money. So maybe you don't have to make the payment, but you need to be setting aside those funds. That's not found money. It's not free money. It's money that you're going to have to repay. And this next screen, so I hope you guys can see this at home. So this is the top half of this screen is a snip from the Bank of America website. I went to B of A, I clicked on the forbearance link, I did a snip, and you're looking at it straight from their website. And it says, if we own your loan, we may be able to provide you a payment deferral or a payment forbearance. May. Bank of America Payment Deferral Program is available for customers who have only one payment due on their loan. Again, this bullet point is under, if you look up there, if we own your loan. So what generally isn't understood is maybe your loan's with Bank of America, but Fannie Mae still owns it. Bank of America is simply servicing the loan for a loan owned by Fannie Mae, and that's most loans. So the Bank of America Payment Forbearance Program, you can't apply for that program until you're already late on your mortgage. That's what happened in 08, is people would ask for help, and the lender would ask for a loan modification, or they'd ask for forbearance. Well, you had to actually be at least 3 months past due in order to be considered for a loan modification. So people had to sit and wait and not make their payment for 3 months in order to get considered for a loan modification that would or would not go. So at the top half of this page, there's the bullet. If a third party owns your loan, for example, Fannie Mae or Freddie Mac, or if your loan is insured by a third party, an FHA loan, we will follow their guidelines and offer you a payment forbearance. Under a payment forbearance, we'll work with you to understand your specific needs and recommend a forbearance period of 3 to 6 months. Now, that's the Bank of America website. What actually happened when 150,000 people called Bank of America, and I'm not picking on Bank of America, this is universal in that loan servicers still have to pay property taxes, they still have to pay homeowners insurance, they can't let the insurance on your property lapse. So they're not really in a position to wait 30 years for those 3 or 6 payments. They're going to need them sooner than that. So the bottom half is an example of someone that called, and this was on, I forget what, this is Yahoo or something, but these people called Bank of America, and this is Miss Stoddard. She was employed, her husband managed a restaurant, and he no longer had a job and didn't know when the restaurant's going to reopen. Even once these orders are lifted, we still don't know when restaurants are going to think they can fill enough tables to make it work. So what she found out was that Bank of America was only willing to suspend her mortgage payments for 3 months. After 3 months, Stoddard says she was told she would need to repay all suspended payments at once, and that reworking her loan wasn't an option. In effect, that means she'd owe three months of deferred mortgage payments plus that month's payment, $8,800 as early as June, far more than she was expecting or able to pay. So when you're talking to the people that you're incubating, I know that they're going to be tempted, because my other concern is people are going to apply for this forbearance that don't really need it, but think, why not? I could use an extra $2,200 a month. Are you kidding me? Who couldn't? So there's going to be some people that maybe apply for this that don't need it, and there's going to be people that apply for this that don't understand it. That's one of the things that you're going to need. That's one of the things that I want you to take away from this, and one of the things that I want you to embrace the people that you're incubating is, hey guys, let's talk about forbearance. Have you considered it? Is it something that you guys think you might need? I've really got two concerns about the next 6 months. One is people putting their money into trying to put their mortgage into forbearance. The other one is people that need to spend their down payment in order to get by over the next 6 months. So this is probably my biggest concern. The federal government is not going to let Fannie and Freddie go away. I used to go to Vegas for trade shows, for fun, for bachelor parties, what have you. I've probably been to Vegas 30 times. People love to gamble. Mortgage-backed securities for jumbo loans are going to come back because there are people out there with an appetite for an 8% return instead of a 7% return or a 5% return. That's going to come back too once we can actually price some of these assets. What to expect from lenders going forward? Fannie, Freddie, and Ginnie Mae, that's the FHA channel, will always be there. What's going to happen is the number of mortgage defaults that we have over the next 6 months, or until we can get our arms around this, is probably going to change some of the underwriting guidelines. I think the biggest change is going to be they're going to require more reserves. Right now, reserves is not even part of Fannie Mae's software when granting an approval. I know that sounds crazy, but it's literally how much money you have doesn't matter. It should, obviously, but right now it's just income and credit score, and that's virtually it. So I think we're going to see a return of assets being a big part of the underwriting. Debt ratios had gone up from 45 to 50%. We might see those go back down. I think we're going to see higher score requirements for second homes and investment properties, simply because they have a higher default risk. I think we'll see the cautious return of jumbo and outside the box lending. The appetite for jumbo MBS and outside the box will return. There's just people who aren't happy. The return on treasuries is like 1%. The return on mortgage-backed securities is about 3%. It's a safe FHA, 3%, maybe 4%. So there are people that are going to be looking for a higher return. These products are going to come back as soon as they can be priced. Something to remember, one of the things I want you to take away from this as well, is the huge changes in the mortgage industry that came about after the collapse in 2008 are now protecting everyone in this industry. It was a very tough time to go through, to have to turn down half the people that called me, people that in 2007 I could have done a loan for, in 2009 I can't. It was a real struggle. It was a struggle for everybody associated with this, because people that you used to be able to get financed, now you couldn't. So in 2008, 2009, while the changes seemed harsh, right now I'm very glad, because everyone that bought real estate in the Summit area in the last decade could actually afford it. So it's not a house of sticks, it's a house of bricks. We've seen the run up in prices, right, in the Summit area, in Eagle, on the other side of Hoosier Pass in Park County. We've seen those run ups. Those run ups were based on people who could actually afford the things they were buying. It wasn't somebody using stated income products. It wasn't somebody who was using straw buyers. It was people who could actually afford the home, who could actually afford the condo, who could afford the second home. So while 08 and 09 were painful, right now we're reaping the benefits of it. It's a much sounder, stronger house today, certainly than it was 12 years ago. And yes, it hurt, but now I'm glad. So lastly, I don't know when, but we'll be okay. Fannie, Freddie are bedrocks. They're not going anywhere. So loans for primary residences, second homes, and investment properties will be there. The other products, the jumbos, the outside the box, I'm confident will come back. There's too big an appetite for higher interest rate products for them not to. We just need to be able to get a handle as an industry on what the price is, what the value is, and what the foreclosure rate's going to be on those products. But it'll come back. And the bedrock of it is still here and never left. So thank you. I tried not to get too technical and too mortgagey, but I wanted you guys to understand that the mortgage-backed security is where virtually all loans go. That if the second half of the pipeline isn't working, the front half of the pipeline jams. I wanted you guys to understand that the run-up in prices in Summit County and Summit area has been valid. It's been based on people that actually had the money. And I want you to know that Fannie and Freddie have figured out how to handle closings, how to handle remote closings, how to handle appraisals. Systems are being put in place to handle all of this. So when the buyers and the sellers are back, and I know you guys are all trying right now, again, we're all on commission, right? When you can put the buyers and sellers together, there will be products available. Of that, I'm confident. So thank you much for your time. Hey, Michael, how are you?
We're doing good. I think we have a couple of questions.
Oh, we do.
We understand if you do have to go, but we're going to try and knock out some of these questions.
Absolutely. Sorry, I went over the hour. Got a little.
Yeah,
so I've got
just a little.
Couple, 54 participants.
Yeah, not bad.
Not bad. It's more than we get in the classroom.
I know. Jack, anonymous question.
Okay.
Are many loans assumable?
So yes, there are, I believe Fannie Mae loans are, I'll have to go back and look. VA loans have always been assumable, and I believe either Fannie or Freddie loans are assumable. I will get an answer back to you on that. I don't know what's a good way for me to, if you want to, you can't ask me anonymously. But while loans are assumable, you got to keep something in mind. 5 years from now, let's say the property is worth $1 million. Let's say the mortgage on it is $500,000. The buyer still has to come up with the difference between 500 and 800. And the $300,000 second mortgage is hard to find. So while some loans are assumable, they often aren't useful because they are so far away from the purchase price that the buyer would still have to go get a massive second mortgage in order to close the deal. So VA loans for sure, and I will check on Fannie. I'll get an answer back to Michael and she can distribute.
Awesome. What is the health of the secondary markets for MBS? Is the Fed buying those up, or are investors still buying?
Investors are buying the guaranteed, the Fannie Freddie. When I say guaranteed, I don't mean guaranteed by the US government. I mean guaranteed by the existence of the Fannie or Freddie corporation. Ginnie Mae loans, FHA loans are guaranteed by the US government. So MBSs from Fannie, from Freddie, from Ginnie Mae, those are actively being sold. Those are moving. But your question's excellent because it's the other products that aren't moving until we can establish what the risk is and what the default rate is going to be in those. Thanks.
Awesome. Good question.
And
then I'm hearing that those who forbear are also having a 75-point hit to their credit rating.
I'm unaware of that.
Okay.
I don't, there isn't any mechanism that would cause that to happen. The only way your credit score would go down is if the bank reports the forbearance. Now, most banks have put in their verbiage, we won't report the mortgages late. It doesn't mean they won't say you're in forbearance. So this is another great question. You really need to understand the program. You have, I mean, the absolute details of the program, because like we saw, it looked like Bank of America was going to help everybody out. And the first bullet point that they had said that they would add the payments to the end of a 30-year mortgage. That's fantastic. It's probably only about 3% of their portfolio. So really understand how it's going to work, when it's going to be due. And that's an excellent question to bring up. What's it going to do to your credit? How is it going? If they don't report anything, there's no reason your credit score should change. The word forbearance should not cause your credit score to change. If the trade line itself is impacted, showing now due 3 payments, yes, there's going to be a hit to your credit score, because it's going to be your largest debt in your credit score, and mortgage rates crush credit scores. If it gets reported that way, a 75-point hit is absolutely possible.
Okay.
Anything else?
Another one of the questions in the chat was, will second home loans be better route than income property?
Always. The rates on second home mortgages require a lower down payment, and the rates are better. And this is why occupancy fraud is the biggest type of fraud in the mortgage industry, because there will be people that buy a home knowing they're never going to stay in it, knowing that it's going to be an investment property, but they understand that telling me it's going to be a second home is going to get them a better rate. And I can't challenge that. I can't say, nope, I'm going to, now if they say, Jack, I live in New York, I'm never going to see this thing. It's just, I'm hoping for appreciation and maybe make some money. I'm going to book that as an investment loan. And the rate right now on an investment condo is probably a full 1.5 higher than a second home condo. You're going from 3.75 to 5.25 if you go from a second home condo to an investment condo. So if the borrower needs to tell everybody from the very beginning of the process that this is a second home. As soon as they tell me that it's going to be an investment property, I don't let them take that back. That's not and I've closed people as an investment property who then have a family member move into the property or something, and I'll refinance that as a second home. But to answer your question, investment rates are always going to be higher than second home. Right now, I think trying to find an investment jumbo product, good luck. I don't think there's a lot of those out there.
Okay.
I saw one more pop up.
I think this is like our last one.
Okay.
Oh no, there's 2 more. Is the option for first and second loans still happening for loans over 625?
So yes, a lot of people will, good question. What you can do to try and increase your the purchasing power of your borrower is a first mortgage to 625,000. It was 575 in Park County, and it was 750 in Eagle County. So what you can do is you can do a 620, let's say Summit County, I can do a first mortgage for 725. I can do a $130,000, $150,000 second mortgage, giving the borrower $775,000 of loan power, and that makes properties closer to $1 million much more purchasable. I will tell you that one of the things that happened, and we had an earlier question, is the secondary market actively buying MBS. I had several large brick and mortar banks send emails saying they're no longer doing second mortgages. So that part has to restart as well. And I haven't gotten an email back saying they have. It was only a couple of brick and mortar banks, but the overall answer to the question is yes. You can stack we used to call them stacks, but you can do a second mortgage with the first to increase the purchasing power of the buyer.
Okay. So if the percent of forbearance rises, will there be liquidity issues for lenders? Where's the money coming?
And I do not believe there will be. The forbearances that we're seeing these aren't loan modifications where we're taking a loan and taking the rate down to 2% for 2 years, 4% for 2 years, 6% for 2 years. That's not on the table right now. What's the only thing that's on the table right now that we're seeing is you cannot pay it for 3 months and then you have to give us all the money. So that's a very good question in terms of liquidity, but I don't think it's going to impact the amount of money that's available in the market. Servicers are going to stay very liquid. They're not offering huge reductions. They're not offering restructurings. They're not offering loan modifications. Those are simply not on the table. So liquidity should not be a challenge.
Okay. And then just to go through, there was one more question that I think you answered, but I want to just make sure we hit his question. So
Please.
Will deferring mortgage payments for 3 months on a primary home affect a buyer's ability to procure a loan on a second home or investment property?
Absolutely.
Okay.
Yeah, any underwriter that sees you're in forbearance, because one of the things I have to provide is a stack of paper the size of a cow's rump that goes to underwriting. One of those documents has to be your most recent mortgage statement. If it shows you're now due for 2 payments or for 3 payments, no underwriter is going to say, sure, you can have another house. So it's a good question, and it's something that's one of the things I want you to pass along to those you're incubating is, and they may tell you, look, I don't have a choice. I have to do this. I get it. So be it. They're going to do what's best for them. But understand that during that forbearance period, they're not buying anything. They're probably not buying a car, but they're certainly not buying a second home. So because that mortgage statement, even if it doesn't show up on their credit bureau, the mortgage statement, there's always, you have to figure out where the landmines are before you step on them, right? And one of them is going to be that mortgage statement is going to show now due for 2 or 3 statements, and it'll likely have the word forbearance on it.
Gotcha.
It'll get kicked out.
Okay, and then the second part of his question was, for non-W-2 workers, will a lack of income at this specific time affect ability to get a loan? How much weight given to 2018, 2019 versus 2020 year-to-date income?
So that's a challenge as well, as how do you underwrite the self-employed? So they too have to sign an affidavit as part of the closing package that says their business has not been impacted by the coronavirus. So, and a lot of borrowers right now have not, because we all got until July 15th to file our taxes. I'm still underwriting, I'm still closing loans based on 2018 and 2017 tax returns. So the borrower I have to ask the borrower for a year to date. It's not audited. They generate it. They sign it and date it, but it comes from them. So I can't speak to the veracity of it, but if your income is low, the basic cutoff for underwriting is if your income is dropped by 15%, underwriters cancel it, or whatever that source was, because some people, again, have several side hustles, right? If any source of income has decreased from one year to the next by 15%, that cash stream cannot be used as part of the underwrite. So I've had people tell me, man, 2019 wasn't quite as good as 2018. I don't know what the number, and I say, don't file. Don't file. Just give me the 18s, give me the 17s. You figure out the 2019s. We are going to need a year to date for 2019. You're going to need to sign it and date it. It's not audited. But I've actually told people either you need to file taxes to give me better numbers, or don't file taxes because I don't want to see bad numbers. So one of the things and actually the vast majority of the people on this call are probably 1099 people. So I think Fannie's going to have to wrestle a little bit with how to underwrite people in this environment. It's an existential threat, right? This wasn't our economy. This wasn't 08. This wasn't a housing crisis. So I don't think Fannie can fairly can say, can penalize you for what we're all going through. But you are going to be asked to sign an affidavit as part of the closing package that says your business is still operating and you're still making money even through the coronavirus pandemic.
Awesome. I think this is our last question.
Okay.
Will filing for unemployment affect the ability to get a loan? I think you said that.
No, it will not. Well, I can't close a loan while you're on unemployment. Having been on unemployment is not seen as a negative. It doesn't show up on your credit bureau. It won't impact your credit score. And if a borrower had unemployment income, really good question. If the borrower had unemployment income in 2018 or 2019, that's a valid source of income. So if they made $40,000 in the first half of the year, were on unemployment for July, and $40,000 in the second half of the year, I get to add that unemployment compensation to their total annual compensation. It is a valid source of income. It will not hurt your credit score. It will not show up on the credit bureau.
But just to be clear, if they're filing for unemployment right now, they can't get a loan while they're on unemployment.
Correct. Not while you're on unemployment, you will not be able to get a loan. You need active employment. We have to be able to verify some form of active employment in order for you to get a Fannie Mae loan. There may be some outside the box products that make a comeback, but in the traditional channel, while you're on unemployment, you're not going to be, because being on unemployment means you don't have a job. And if you don't have a job, Fannie Mae is not going to give you a loan. It will not adversely impact you once you're off unemployment. But while you're on unemployment, you're pretty much frozen in terms of buying and selling real estate. Not selling, in terms of buying.
Gotcha. Perfect. All right. Well, just quickly looking through, I don't see anything else except thank yous to you. Oh gosh, sorry, I lied. We have 3 more. Are recent implementations of HOA short-term rental restrictions affecting lending at all?
No. It might impact. I'm going to base it on the tax return. I'm going to base it on the income that you claim. So because those activities don't actually filter all the way through to your tax return, they might impact how much money you can make off a property, but I'm still just going to use your tax return, and whatever the status is of the property is not going to be an issue. Fannie has come out and said, we understand that some people are going to buy a second home. It's not their primary residence, and we understand that when they're not there, they may want to rent it. So you can have rental income on the property, and I can still underwrite it as a second home from looking at, in terms of a refinance, for example. So that is a challenge maybe for how you rent, a challenge for your expenses for the city of Breckenridge. It's not going to be a challenge for lending.
Okay. What is the current debt to income ratio that is being used? Is it the same as pre-COVID?
It is for now. And that's, and that debt ratio is 50%. And by debt ratio, what we're talking about is your gross monthly income versus the debts that report to the credit bureau. So things like, I don't know, gym memberships, that kind of stuff, don't impact your debt ratio. Car payments, mortgage payments, credit cards, student loans. Those are really the 4 biggies that I see on a credit bureau. And that's going to be versus your gross monthly income. So if we're 1099s, for example, I would take your last 2 years of filed tax returns and average them over 24 months. If your business is more than 5 years old, I can take just what your most recent year of taxes and to get a 12 or a 24-month average. That's your gross income. The debt ratio is still 50%. It was 45% only 2 years ago. So after this, we may see it go back to 45%. at least for a while. I would be surprised if we don't see any underwriting guideline changes after this. I'd be surprised.
Gotcha. And then this last question, is PUA the same for that? I don't know what that's referring to. So Katie, maybe you can elaborate a little bit on your question, or Jack, maybe if you know what she's talking
I'm
about.
going to Google PUA.
Okay. So Katie, I think you're still on with us. If you want to, either in the chat or in the questions, tell us what PUA is.
Unemployment.
And then let us know what you're trying to compare it to, maybe?
I'm not sure what the...
Maybe we'll just move on. Matt has one more question. What is HOA delinquency percent that lenders will allow in HOA questionnaire as delinquency might be going up?
It's a great question. I don't know because I haven't run into it in Summit County. Most of the HOAs in Summit County, and this kind of goes back to what I was talking about after 08 and 09, is the delinquency ratio on HOAs is extremely low in the Summit area. At the Village, it's extremely low. So I can get that information to Michael. She can distribute it. I want to say it's 10%, and it's, I believe, more than 3 months delinquent. So it's not just 1 month delinquent. It's they want to know how many are 3 months delinquent, and I really haven't run into that in Summit County as that killing deals. And I've done a lot of condo loans. So, but I will get that answered to Michael.
Great, that's awesome. So then, just to expand on Katie's question,
yeah,
the PUA is Pandemic Unemployment Assistance.
Okay.
And that was referring to how unemployment affects loans right now, since it is not conventional unemployment.
It's still going to be one thing we should understand is we'll probably get a 1099 for your unemployment, and you'll have to pay taxes on it. It's considered valid income, including the additional $600 a month. I think she may be talking about the additional $600 a month of unemployment that the federal government's offering for, I think, 39 weeks, something along those lines. That's still going to be valid income. And so you're going to get a 1099 and you're going to end up paying taxes on it. I think when you file for unemployment, you have to ask them whether you want them to hold taxes for you or whether you want to pay them at the end of the year. So that is valid income, including the additional $600, because it's probably going to be, well, I'll tell you what, if it's on your 1099, it's valid. So, and I'd be shocked if it's not on your 1099 and shocked if we don't have to pay taxes on it.
Great. Awesome. I think we're done.
Cool.
Awesome.
All right.
Yeah. So if we still have a couple people on, but we're going to try and get this recording put on our YouTube page. We'll include the link in the email that we send out. We will include Jack's information, and a couple of those questions had a little bit more information. We'll try and include links to those. If you have any other questions, please feel free to reach out. And if you want more finance information, we will be hosting this class again, hopefully live in like human.
I'll be wearing a mask in October.
No, we hopefully will not be wearing masks in October. I'm hoping.
Hopefully not. Everybody
Okay.
stay healthy.
Yeah, absolutely. All right. Well, thank you so much for joining us, and we appreciate Jack doing this pretty last minute. So thank you very much.
Yeah, and thanks everybody for, again, I know your time's valuable. I know we're all trying to hustle. I really appreciate your time. I hope it was helpful. If there's any feedback you want to give to Michael, she'll certainly forward it on to me, and we'll try and answer those couple questions that we weren't able to get clear answers for here in the last 10 minutes.
Awesome. I'm ending this meeting right now. Bye, everybody.
Bye, everybody.